So we'll be doing a bit of a market update on, what are the events that transpired since I last spoke to you all, and then also, doing a quick analysis on where we might be in the current market cycle. I feel there's a little bit of concerns with the recent drawdowns, with the recent events, and so as a result, it may be good to just take a look at where we could go from here. I just saw a raised hand. I think if there's any questions, feel free to, of course, type them in the chat, and we'll be happy to answer them throughout the presentation.
Yeah, exactly.
Cool. With that in mind, let's first, before going into really what happened in crypto, I think it's really important to also take a look at, any kind of macro-driven events and what's been going on in the traditional space as well. So in terms of macro, I think I'm going to keep it here at a very high level, but there's still that kind of uncertainty growing from tariffs and the resulting trade wars and what this may mean for inflation in the US, but also inflation in the countries that are targeted by these tariffs. So that is, still leaving some question marks. At the same time, last week or recently we actually got some inflation numbers from the US from CPI and PPI, which actually were more favorable than expected. So even though, this is posing some questions on the trajectory of rate cuts and inflation, it does seem that everything is still largely on track. And this is what Jerome Powell also mentioned at the latest FOMC meeting minutes too. So there's a little bit of uncertainty still in the US, but if we move over to Europe, there's still some growing geopolitical risk, I would say. Particularly as we've recently found that the U.S. is slowing down, or they're kind of stopping their support for Ukraine, and this means that Europe will have to take the burden here, or will have to finance this conflict. And we've recently seen that the German government, or the Germans, have recently voted in favor of a 500 billion infrastructure fund that should also go into defense. So of course, this fund has to be, funded in one way, and we may see higher borrowing costs in Europe as a result. So generally speaking, macro is still not yet out the winds. We have a little bit of clarity or a little bit of sunlight in some areas, but I think it's worth also keeping that in mind as we take you through the latest events and where we could go from here. But moving on to crypto, I think we'll just focus on Bitcoin for now for this slide. And it's quite funny because if you draw, just a monthly price chart, this month would look flat. But realistically, it's been a very busy month. I think, I speak for both Kareem and I that the first 3 months of this year have actually felt like the last 4 years combined in terms of just how much news and how many developments we're seeing in the crypto space. I mean, starting with the crypto summit in early March, we got the news that, of course, following the inauguration and his presidency, that crypto is going to be a very important, feature for this administration, and they had their very first crypto summit at the start of March, and this coincided also with a lot of, rumors, but also an incoming executive order that was signed regarding crypto reserves. On the surface, this is still a positive development. We're still going towards the goals that Donald Trump had set out at the start of his campaign. But to me, it did seem that markets kind of viewed or were largely impatient with these news. We saw this following the inauguration, where markets became impatient with the pro-rhetoric and wanted structural developments. And I think this is something similar again, where the lack of details or on these two topics, or on the crypto reserve specifically, started, bringing markets slightly down because no details were really shared, or as much as the market had expected. So this is what coincided with a little bit of, that up and down movement at the start to mid-March. However, there were also still several, positive news and developments to Bitcoin specifically. I mean, Pakistan is a small story relative to the rest of the developments, but it's another cool development that shows some of Bitcoin's others potential. That it can be used to, diversify your energy grid, or you can use excess energy to actually mine Bitcoin and reserve and as a result receive a reward for it. So that's another cool story that we kind of pointed out. And then another one, which we received last week, was to do with the SEC. The SEC had actually declared that proof of work rewards, such as those that are earned in the Bitcoin system, that they're not securities. We've heard Donald Trump say that he wants to make, Bitcoin mining really the base in the US, and so this may be the first kind of step to getting, more developments for this subsector. Altogether, though, in the background, we're just seeing the strategic reserve race continue. There's even more live strategic Bitcoin reserve bills open in the US. Senator Lumens has also opened up another Bitcoin-related bill, which would see them be able to also invest into Bitcoin ETPs in the US. So there's a lot of developments, and this is not just to the nation state level, but also we've seen strategy add to their stash, and they now hold over 500 million Bitcoin. So altogether, been a very busy month for Bitcoin. The price hasn't broken out yet following the downturn, but it is still showing relative resilience. We're above, a lot of the kind of key structural support levels, as we'll show later in the slide. So all in all, it was a busy but rather flat month, actually. And part of the reason, I think, is, when we take a look at basis. So we touched upon this in our last session as well, when I was here together with Michael. And basis is the basis trade is a key way for institutions to actually get exposure to crypto assets, but remaining market neutral. And so, in a way, what you can see from this chart is that the basis has significantly come down following the market euphoria in November, December. And that's because the futures and the spot prices are becoming far closer together, which in turn means that the basis has shrunk. And therefore the yield, the difference, that institutions can pick up by doing this trade is smaller. What that means then is that we see less, participation from these institutions. And the main way that they, tend to get their basis exposure is actually through, the US spot Bitcoin ETFs. And the reason for this is because, aside from all the benefits that we believe in ETPs and ETFs, generally speaking, for crypto, one main benefit for these hedge funds or market participants is that, the Bitcoin ETFs, ETPs, they operate in, traditional environments. And so as a result, it's far more efficient for them to do basis trading with ETPs, ETFs than it would be for a direct holding. But nevertheless, what we saw with, Bitcoin ETF flows, it largely mirrored the price action and largely mirrored also the basis. But one outlier was that actually last week we saw around $745 million in net flows into the Bitcoin ETFs in the US, which is actually the first time we've seen a positive week since the end of January. And it's a real outlier because while the basis remains shrunken, we have seen these inflows. And so to me, that, shows that it's not institutions or market neutral participants, but rather it's, longer term, like longer term holders who are doing this as a long-term investment, which is a very positive signal, as it shows that sentiment may also be coming back to the market. All right. Moving on from Bitcoin to Ethereum and Solana real quick. I'm going to start with Ethereum here because it has been a bit of a problem child, not only recently but over the last cycle, I would say. Um, we started the end of the month last month with knowledge that, Aya Miyaguchi is going to be the new Ethereum Foundation president. While in itself, we're still waiting to see what this really means for the direction of the foundation. It's a good thing that we're seeing this change because the foundation itself has come under a lot of scrutiny over the last, yeah, again, over the last few years because of the fact that yes, they've been selling Ethereum, but I think the main kind of problem is that development to continue competing with its, all the competitors it now has been far too slow. So this was seen as a kind of positive, and we may still see the benefits of this as well. The SEC actually also dropped several investigations related to the Ethereum ecosystem, such as the developer consensus, who made the MetaMask wallet, such as Uniswap, which is a key DeFi player in Ethereum, and OpenSea, the largest NFT platform in the crypto ecosystem. So these are all within the Ethereum world. And as a result, the dropping of these, investigations is a positive thing. But as the market turned, so did Ethereum. And the one problem I think that we noted during this downturn was also the fact that the Ethereum Pectra upgrade was delayed. We're going to touch upon this a little bit more detail too. But all in all, I think the week's events really highlighted the fact that, yeah, Ethereum is facing a bit of a decline, and this is not just in isolation to this cycle. It recently scraped actually around 1.9K, which is the level it last saw in mid to late 2023, which, in itself may not present as a bad thing because you could argue it's a potentially strategic entry point, but the fact that it also hasn't reached a new all-time high in the last year or so, when a lot of other major crypto assets have, does point towards a maybe potentially bigger problem. If we look at the Solana side, it also, of course, kind of downturned with the broader market, but it also was facing some issues of its own, I would say. It had the FTX estate unlock, where $1.5 billion worth of Solana entered the market in early March. And a lot of the kind of more speculative behavior via meme coins on Solana kind of slowed down after the Trump launch, actually, I would say. So it faced similar market kind of movements as the rest of the market. But it did have positive news towards the last few weeks as well. I mean, on the 17th, we got news that Solana CME futures, that they're going to go live. So this is another kind of deepening of the kind of financial plugging that the Solana world or the Solana token actually has. And it may bring about some institutional participation, right? I mentioned in the last few slides that, institutions like to use futures and spot to be market neutral and yet generate yield. And now this is actually going to be possible on Solana too. Tokenization was a big trend throughout the last month. We saw BUIDL, which is going to be expanded now to the Solana ecosystem, which is, a big testament to the network's abilities. And then we actually also saw the fact that Fidelity wants to also launch a tokenized fund on Ethereum. So this was kind of something we noted for both networks. But a little bit what may have gone under the radar, and I'm going to relate to Kareem here as well, is that Solana had a few improvement proposals that went live in the last 2 weeks or so. And I think they were quite, important to the ecosystem health. So maybe you could shed some light on what these were and yeah, just give us your Kareem take on this.
Absolutely. Thank you, Max. So yeah, as Max alluded to, we had two proposals. The first one was pertaining to Solana's inflation. So at the moment, Solana, or even before the proposal, Solana was fixated on, or was reliant on a fixed schedule for inflation, meaning that inflation was expected to go in a specific schedule for the next couple of years. Of course, the number varies depending on how much people are staking. However, the inflation figure itself wasn't dependent on the fact that it wasn't dynamically adjusting according to the network's participation and yeah, and how much people are staking, generally speaking. So this is what the first proposal was talking about. This was called SIMD 28. It didn't pass, and it didn't pass even though from an outsider's perspective, like it could have been a good thing because it means that the one of the outcomes for the proposal was to reduce the network's inflation, based upon the fact that if more than 60, if the staking participation rate is more than 65%, then the emissions would lower, and then vice versa, in order to encourage an active staking economy. The problem with it was not all the validators would have been profitable if this model was implemented. And this meant that there was a potential risk for centralization, meaning that all the smaller validators could be were probably priced out, and they would have had to shut down their operations, and yeah, just left a smaller portion of the validators that are able to stake in a profitable manner. So yeah, this proposal didn't pass. And then there was another proposal as well, which so to take a step back before we talk about this, there are validators and there are stakers. Validators are entities that are acting as a full node, meaning that they stake a very huge amount of Sol, and they run as the kind of nodes that have the whole history of the Solana blockchain on their devices. And they are ultimately considered the, you know, the full validators
Yeah.
for lack of better terms. The stakers on the other side, or the retail, or pretty much anyone that doesn't have the operational complexity to run such a setup, or people that have, you know, just a small amount of SOL that want to stake it in order to prevent any sort of holders dilution, if you may. So in the current setup, validate like there was no specific arrangement between validators and stakers, meaning that whenever validators earn some fees from users interacting on the network, there was not a specific, or there was not a transparent and a straightforward way for validators to share this revenue with stakers, or as we sometimes call them, delegators. This only dependent on certain validators having a customized arrangement with certain stakers in order to do so. So this, of course, isn't really isn't doesn't live up to the ethos of the transparency and the public nature of blockchain, which is why this proposal was introduced to essentially create a programmed way so that validators are able to automatically share this kind of yield and revenue with stakers directly, without waiting or without relying on any third party arrangements or off-chain agreements, or however you want to call them. The second one did pass, the one that we just spoke about. So this is a step forward, again, to help Solana become a more transparent blockchain, and to also encourage smaller entities, meaning like retail, to further stake or to further contribute some of their soul to the network security, and help it grow and become more decentralized. Um, so this is pertaining to the two Solana proposals that we were just talking about. But as Max also suggested, or not suggested, pointed out at the beginning, we did also have the Ethereum Pectra upgrade. So as a quick recap, there were two test net deployments for the Pectra upgrade. Both of them ran into some issues, again, as Max pointed out. So in order to avoid implementing the upgrade without really seeing how it would how it would operate without any issues on mainnet, the Ethereum dev community decided to launch a third testnet. The upgrade is actually implemented on the third testnet today. So we are going to find out how this upgrade fared out. And according to this, if everything went smoothly, then we would expect the upgrade itself to happen, I would say, within a month from, end of April. This was the projections based on the latest community dev community calls that happened. But so yeah, this is the update about the Pectra itself. But what is the upgrade? The upgrade is the next major upgrade since the Denkun one, which happened almost a year and a half ago now, or almost a year ago.
Yeah.
And
Yeah.
time flies by in crypto. You
You
uh,
age by the minute, yeah.
exactly. So the Pectra upgrade, it introduces a lot of, I would say it focuses on a lot of areas for improving the network. I think it has somewhere from 6 to 10 different areas that the upgrade will focus on. However, there are two mainly that stand out. These two being that if you use MetaMask, or if you're a normal Ethereum user and you are familiar with MetaMask, MetaMask is quite simple, meaning that it's not a smart wallet. If you look at fintech platforms, you're always able to use things like, sign in with your Google ID or with your Web2 credentials. Crypto doesn't have this functionality. Some of the newer networks do, but a network like Ethereum doesn't have this. So this is essentially the first upgrade, introducing something called account abstraction. So account abstraction transforms your simpler wallets into more complex and more functional wallets. What does it do exactly? As I just said, it will allow you to log in with your Web2 credentials so that if you lose your private seed phrase, it's not the end of the world, because in fintech you can reset your password, you can contact customer service. That's not really an option within the older generation of wallets within crypto, specifically again on Ethereum. So that's the first upgrade. The second upgrade is that it would allow you as a user to pay with other currencies beyond just ETH. So let's say you're swapping from USDC to ETH on Ethereum using MetaMask. Initially, you had to have ETH in your wallet. With this upgrade, no, you can pay with USDC, or you can pay even with a third currency. But that doesn't take away from the role function of ETH within this dynamic, because at the end of the day, if you pay with USDC and the background, USDC will be converted to ETH, and all of this will be streamlined and abstracted away from your eyes. The whole point of it is to just make this as much of a seamless experience as much as possible, reminiscing or a reminiscent experience of fintech. Um,
Yeah. No, makes
there's,
sense.
sorry, Max.
No, that makes sense. I mean, I think we've all been kind of hoping for, some a little bit more user-friendly features on Ethereum. It's a lot of, we know that this stuff, some of it, competitor networks or competitor wallets and that are not in the Ethereum ecosystem already provide. But again, Ethereum is the largest ecosystem in the crypto space, and it still has a very sticky user base. So if it can attract new ones by being more user friendly, that's a huge plus in my
Abs-
eyes. Sorry, I
abs-
didn't interrupt you. Go on.
No, no, no. I'm saying I'm agreeing with you. And the fact that, again, as we have reiterated in this call and other calls, Ethereum really is specifically the hub of tokenization, being able to build applications as such and then create and then simplifying the user tooling that would allow everyone to interact with it in quite an easy manner. That's the way forward, especially again, because most of the newer generation smart contract platforms or the newer generation app stores, they all focus really on on user abstraction,
Yeah,
making it as much of a seamless experience as possible. So the chart that you see in front of you, just as one last point, you can already see that Ethereum, certain applications have been implementing the standard for account abstraction. This is what the ERC 4337 is, which is again one of the improvements of the upgrade. However, this was done on an individual basis. This was not done as a standard protocol that everyone can abide to on the Ethereum network. And it's quite impressive that Ethereum has seen this surge in the last 5 months specifically, just before February when things slowed down a bit. So it's quite impressive because it means that there is a very large appetite for this. Yeah, very large appetite for this on the network, and we can expect to see even more and more user engagement in the coming months.
cool. Thanks a lot. Yeah, I think we covered a bit Bitcoin, Ethereum, Solana specifically, but as we mentioned on yeah, on this call a few times already, crypto is really moving a bit at light speed at the moment. Maybe you can break down some of the other developments that we've been seeing.
Absolutely. So the one thing that really has been reflective of the crypto industry in the last few months is the the pace of regulatory developments happening within the US. I think we're entering an era where the current administration is just reversing all the anti-crypto policies that were in place and are essentially creating on-ramps in order to acknowledge certain things about crypto that are quite useful for the US economy and for innovation, generally speaking. One of these things, obviously, being stablecoins. So there was a bill specifically related to stablecoins, which was called the Genius Act, if I remember it correctly. This is essentially a regulation that recognizes stablecoins as legal tenders, or not as legal tenders, as payment currencies, and it essentially it categorizes them into either ones that are regulated by state regulators or by federal regulators. And the whole point of this is to essentially create a supervisory supervision, yeah, over the sector, if you may, while also allowing banks potentially to start issuing their own stable coins and allowing enterprises to start issuing their stable coins. Um, so just as a repercussion of the fact that this Genius Act just got passed in the Senate about 2 weeks ago by the Banking Committee, it passed with a bipartisan with a bipartisan approval of, I think it was 18 to a small number. So this is now going to be voted on, broadly speaking, in the Senate itself, and this is the one of the few bills that has made it so far, like have made it, yeah, um, pretty much so far in both either Congress or Senate. So as a repercussion of this, we're now seeing that a lot of enterprises and firms are jumping on the bandwagon. Yesterday, we just heard that Fidelity is planning to launch their stablecoin. Bank of America, I think this was about 2, 3 weeks ago. They pretty much announced that they are indeed planning to also launch their stablecoin as soon as regulations are put in place that allows them to do so. Wyoming is one of the very, I think it's the only state that is pretty much advancing towards launching their own stablecoin. I think Max mentioned earlier that we have certain states deciding to put like implementing an alternative to the Bitcoin strategic reserve. Wyoming is doing that, but also taking it a step further by yeah, having their own stablecoin. So it shows their bullishness towards the ecosystem and the industry. And then most recently, Trump's World Liberty, which is I would say the crypto arm of the Trump organization or the Trump-backed organization that like their venture started off by announcing a lending and borrowing protocol built on Aave. This was announced almost 6 months ago. They've been adding to their own crypto stack, and I think they have at the moment around 250 million worth of crypto assets spread across many different tokens, mostly of the large ones and DeFi tokens. So we did actually do a newsletter about this because they announced that they were trying to venture into other parts of the crypto financial ecosystem. And there was some certain signs that they were going to launch a stable coin. So this is quite exciting to see it that they actually did launch it yesterday. It's going to be on the Binance chain and Ethereum. And yeah, this shows that there's going to be more and more integrations and more bridges between TradFi and DeFi as we move forward. So this is on the stable coins vertical. We did also have some quite monumental news, I would say. So for instance, Binance secured their largest investment from MGX. And the cool thing about this deal was that it was all done in stable coins. This is the first of its kind to see such an investment slash transaction in a huge amount as such. And it shows also that, you know, even the most detested players within the ecosystem, like Binance, was at some point considered a black swan because of all the regulatory choke points around it. We can see now that the sentiment is changing. We also saw Kraken being or Kraken acquiring Ninja Traders, one of the largest derivative platforms or futures platforms. Um, this is one of the largest crypto slash TradFi financial deals in the history of crypto by far. So this also shows that, yeah, there is an growing appetite for the ecosystem. And then also we saw Coinbase, they said that they are, yeah, nearing an acquisition of Deribit, which is one of the largest futures platforms in the ecosystem.
Yeah.
Then, yeah, last but not least, Trump Media shares, which is another arm different from Trump World Liberty. Trump World Liberty is just focused on crypto, whereas Trump Media is more of a media conglomerate that is venturing into finance, fintech, and crypto. They also announced that they are going to launch an ETF for crypto.com, uh, and potentially more others down the line. So yeah, as we can see that there's a lot going on, and the again the
Yeah.
entertaining thing about all of this is it was all in March, but that was not even the end of it. So what else happened, Max?
Yeah, we could have gone on about this for hours. We could have just talked about this actually, but there's just so much happening. And yeah, I mean, the Trump media news was on the ETF deal was also interesting to see. But yeah, the other from the aside from the news that you covered, there was some news that we put under miscellaneous. One of them being like the kind of fee switch or more the revenue sharing revolution that we're seeing in the DeFi space. And this is actually a prediction we also made during our market outlook of 2025. DeFi is a sector we've always been very bullish on. But the one issue that I would argue it had, or the one issue that, yeah, the very issue it had was that while it's while the projects itself were very useful, the tokens themselves were not very investable. And what I mean by that is that a lot of the benefits of these projects weren't actually passed down to the end token holder. Now with the more, pro crypto environment and administration in the US, we're seeing that, these DeFi projects are behaving more like, traditional equities in a way, like traditional startups in the sense that they can implement a little bit more features to their token than what was previously possible because under the previous administration, they were firing kind of Wells notices left, right, and center to the DeFi projects. Now that's not happening anymore. And so thanks to this, pro crypto environment, we're seeing a lot of them, pass down revenue to the end user in two different ways. We're seeing, some protocols turn on what is called fee switches, where, in some shape or form, the revenue that these projects make get programmatically shared with the token holder. We're seeing this on Aave, we're seeing this on Uniswap. But we're also seeing more of these projects engage in, buybacks, token buybacks. This is similar to, what you would see in the traditional space with share buybacks. And there's also some projects going down this avenue like DYDX. So there's a lot more. We could go on this a lot more. I think Hyperliquid also have something similar. But altogether, what we're seeing from the DeFi space is that the tokens will be far more investable from this point onwards. And a little bit of related news to those who were here with us in the last session is with regards to the Bybit hacker. Um, the Bybit hacker actually used Tornado Cash, which is a kind of like transaction mixer to try to siphon away some of the funds it managed to take from the exchange. And now there's actually the founder or the co-founder of Tornado Cash is actually set to go on trial for conspiracy to commit money laundering. And I don't need to, we don't mean to talk about this in specific, but I just kind of was also curious to gauge the audience's view on this point. Uh, the founder really, created a technology. And because that technology is now being misused or is in the hands of the wrong person, the co-founder is in legal troubles. And in my view, my personal view, just to be clear, a technology is an innovation that can't you should segregate away from the end use. So if we think about iPhones, how many crimes that we don't know about are happening because someone texted something on an iPhone? Are the people who are Apple liable for this or not? So it's kind of raises a very kind of interesting dilemma here, a little bit of a, one that I think will have some different views on as well, depending on who you are. But then in other news, we had actually BlackRock come over to Switzerland, to where we're actually based in. And that's, another kind of stamp of approval for firstly what we're doing here at 21 Shares, but also of the wider industry. I mean, BlackRock, of course, are an incredible institution, but for our European investors and more so for our Swiss investors, you guys will all know that 21 Shares, was the very first to launch a physically backed crypto ETP in Europe. And so, we also recently had a campaign across Switzerland where if you are based in Zurich, you also see a couple of, yellow billboards everywhere, and that's us. And it's a good reminder that, here in Switzerland, we pride ourselves on our, innovation and being, first movers in the crypto space, and that is what 21 Shares still is. But yeah, another stamp of approval for the wider industry. Putting,
How's yeah, how did the sectors perform
yeah, I
moving just
think,
off the news?
yeah, exactly. We can just look at this chart itself. I think it speaks for itself that, we've seen a downturn in Bitcoin, Ethereum, Solana, but this is not just to the majors, and it's happening really across all the crypto space to get all together. But it's not just crypto, right? We mentioned macro at the beginning, and macro is really the driving factor between what's bringing the market down, I would say. Equities, they were in need also for a cool down, I would say. If you look at the S&P, it hadn't had a 10% drawdown or more since 3 years ago, I think in 2022. So market was a bit overheated, and now it seems that we've faced the short-term pain and hopefully are in a position where, we can have some more long-term gain, which I think is a great segue to, where are we in this cycle and where we could go from here. The recent downturn may have caught people a bit off guard, or they may have been worried that, we're not headed towards the bull run that we promised. And I would just try to take a look at this chart that if we neglect the very first cycle it had and just focus on the most recent cycles, Bitcoin is very much still on track to, continue its cyclical performance, which should, work as a little bit of, you know, a bit of an aid to those who are potentially thinking that we're off track here. So with that in mind, I think Kareem, you also wanted to quickly take a look at the broader market and where we stand as well.
Yeah. So what we are looking at here is the total crypto market cap, excluding the top 10 crypto assets and stable coins. This shows that for the first time this cycle, there is really quite a wide gap between Bitcoin and the rest of the market. Because as you can see, currently we're at the same levels as the breadth of the summer of last year. And it is also how the whole Bitcoin ETF rally started. Like right now we're at the same valuation at that time. And you can even compare it to the summer of 2021 when the China ban happened. So why are we talking about this? Well, it shows you that, yeah, there is really a disconnect. Bitcoin has sort of proven its product market fit, and it is able to not just product market fit, but it's institutionalization, emboldened by the fact that you have ETFs, you have companies buying through yeah, hedge funds, TradFi, generally speaking, investing into Bitcoin via ETFs and creating some sort of sustained level of demand that altcoins are not enjoying at the moment. However, of course, this all can change with the barrage of altcoin ETFs that have been filed in the US which might lead to an altcoin, yeah, a broader excitement around the altcoin segment, and all the assets beyond just the, the typical suspects that we mostly talk about all the time. So yeah, that's just where we are. I think, yeah, maybe just one last point. We're right now at 244 billion, so it shows we have a little bit of breathing space before we reach the next resistance stage. So yeah, if we don't have any more surprising macro news for the next few days, I think the market should be looking good. Yeah, just at least until the next round of either regulatory developments or macro, or even the next April 2nd, which is when some of Trump tariffs should go into effect. I think this should give us more clarity about where we're going to be heading next.
Agreed.
What we are looking at here is MVRV. So MVRV just in different flavors and variations. So for MVRV stands for like it compares Bitcoin's market value to realized value. Market value is just its market cap, and then realized value is the value of the last time some of these coins have been moved on chain. So what you are looking at here is that MVRV is in a typical fashion used to time the market bottoms and tops. However, what we are seeing here is that over the years, usually you would need to see the MVRV ratio before, like, above 4 in order to reach the super euphoric phase, which usually precedes the market nose diving quite significantly after. However, as you can see from the chart, we've been on a progressive decline over the years, which kind of makes sense because it means that, the market is becoming a little bit more mature, just Bitcoin in it of itself. We're not talking about anything else here. And it shows that we don't need to, the Bitcoin doesn't need to grow by 3,000% in order to reach the same level of euphoria that we experienced in the last cycle. So this gives you sort of a sobering view about where Bitcoin is and the market cycle is. But as we also always reiterate, you cannot look at any of these indicators in silo. You always have to combine them with other metrics in order to have a more holistic view. Because yeah, especially with new factors going into play like ETFs, like people like using crypto maybe for more traditional activities beyond just the boundaries of the ecosystem. So all of these things have to always be taken into account in order to have a more, sober and holistic view of where we are.
Makes sense. Thanks a lot.
Then we also have the pi cycle top, which is in a very simple sense, it compares Bitcoin's moving averages. As you can see from here, it acts as a dynamic support and resistance. Like it compares the 111 moving average versus the 350-day moving average. In an upturn or in an uptrend, usually the 111 is acting as a dynamic squidgy line of support. That doesn't mean that Bitcoin doesn't fall below it. It does. That does happen sometimes. We saw this in the summer. We saw that in the last summer as well. So just what we are trying to show here is that usually, in order for us to feel comfortable that, or to feel more statistically confident that we've reached the top, Bitcoin usually touches the 350 moving average, which is the green line. And even though we touched it at the beginning of last year, sorry, at the end of 2023, because of all the euphoria that was triggered by the ETF launch, or the excitement or the anticipation of the ETF launch, it also shows you that maybe this cycle could be a bit different in terms of its dynamic and in terms of its structure and in terms of how long this could last. So yeah, that's another cool metric to be mindful of as the year goes.
Yeah, thanks. I think also what we see is that they usually those two lines that you indicated as, resistance and support levels, they actually tend to like cross each other
Yeah.
when we reach a peak. Cool.
Yes. Yes. Yes.
And
Exactly.
that hasn't happened yet, right?
Yeah.
So that's a good thing as well.
Yeah.
One indicator that we actually take a look at and combines a bit macro and, crypto altogether, but it's generally true for, all assets which are still perceived as largely risk on, is that M2 growth has a very close correlation with, risk on supply, like risk on assets growing. And the reason for this is because, as more liquidity is available in financial systems, we see this, start to seep into more risk on assets. We saw this significantly following, COVID when rates were essentially nothing and there was a lot of excess liquidity in the financial system. And we're seeing that throughout 2024, Bitcoin had an extremely close correlation with M2 money supply, and I think it was around 90% or something like this. But when we took a look at this indicator, we noticed actually that if you lag Bitcoin's price by 10 weeks, it has an even closer relationship. And the logic here kind of follows that, as liquidity is injected into the system, it takes a couple of weeks for this to feed into Bitcoin. And that's just a natural, phenomenon which happens altogether. And what we've seen over, the last 10 weeks preceding this is that money supply was actually growing. And so the fact that money supply is growing may mean that we may see a little bit of a kind of reversal in Bitcoin's price as well. It turned down amid the downturn of money supply, but also among all the macro factors we discussed. And now, given that it was up for the last 10 weeks, we may see this reversal in Bitcoin's price as well. And just another trend to look at is kind of accumulation and distribution. It's important to kind of get an idea into what are holders actually doing. And typically speaking, I would say that, each market, each cycle, each bull cycle really ends with aggressive accumulation at the peak. So you can see that in 2018, you can see that in 2014, and you can see that in the second peak of 2021. And the reason for this is because market, he reaches a really overheated level, and buying pressure just cannot sustain it. And as a result, you see the market turn downwards quite sharply. And what we're seeing in this case is a little bit different to that, and we're actually seeing that, the nearing the peak, we didn't have aggressive accumulation. You can see that it's actually closer to zero or distribution levels, which showed that while we were nearing it, people already started distributing their Bitcoin. So in anticipation, and this kind of preemptive distribution kind of really matches what we saw with the first peak of 2021, which coincided with the China ban. And later, Bitcoin went on to do another, higher leg up, which is something that we might actually see play out in this cycle as well. We're already seeing, a shift towards people accumulating, and so that's a bullish sign, I would say, for the market, that it's not reached the, tired, overheated nature that signals a top.
Uh,
If you look at yeah, sorry, Kareem, did you want to add anything?
no, no, no. I'm just agreeing with you.
I'm glad. Good, we're on the same page. But I mean, also, if you look at the long-term holders, you kind of see this trend in more granularity, I guess you could say, where, the long-term holder distribution, like the long-term holder, like how much assets they're picking up, has now turned in from distribution into accumulation, as you can see from, the orange line starting to pick up, which shows that we're entering a period of like kind of peak spending. And yeah, long-term holders, they typically accumulate, before, the market kind of reverses back to the positive. And these are really our kind of knights in shining armor. These guys have long-term belief in the asset class, and if they're now still continuing to accumulate, even though we assume that they, are long-term holders and there's no need for them to accumulate at this price from a, pricing perspective, but they still have conviction, is a really bullish signal as well, and one that may signal that we are out of the current downturn and maybe into more favorable conditions.
Another cool metric that has some historical precedence is the hash ribbon indicator. So this essentially compares the 30-day moving average of Bitcoin's hash rate compared to Bitcoin's hash rate over the 60-day moving average of Bitcoin's hash rate. Um, the reason why it's quite impactful because miners are net sellers at the end of the day, even though they are, I would say, supporters of the ecosystem, because at the end of the day, they do need Bitcoin to maintain its value. They are service providers and they do need to cover their operational expenses. So when the market turns against them, they do become a net seller because they do have a reason to sell more of their stash in order to cover the expenses of their, yeah, of their operations. So what you are seeing here is that when the 30-day moving average, when this when the 60-day moving average is larger than the 30-day moving average, this signals a capitulation. And this
Yeah,
capitulation ends when this dynamic is turned around, when the 30-day moving average is larger than the 60-day moving average. So as you can see from here, this signal was triggered almost 3 times over the last 2 years now. And every time that it signaled this down below, like in the bottom half of the chart, you can see that Bitcoin uh, pretty much acted pretty like performed quite well the following weeks and months, because yeah, as we just said, they turned from from net sellers into accumulators, or at least they have less of a tendency to aggressively sell some of their existing stash. So this, for the first time since July of last year, this indicator was just triggered again, because it meant that yeah, since almost December, miners are starting to sell less at the moment, which is a good and yeah, a positive outlook and a trajectory for Bitcoin in the coming months.
makes sense. And yeah, I think the period there that you see in red for a longer time is typical of their behavior, like right after a halving, which of course had happened in April. So
Yeah.
yeah, no, cool. Thanks for taking us through that. What about stable coins? Do you want to kind of talk about a bit about the kind of liquidity that is sidelined, I think, in the crypto space?
Yeah, so as we've already said, I think there's a lot of developments around stablecoins. They have proved they are crypto's killer use case, because payments is not one of the easiest, one of the most, uh, one of the industries that is ripe for disruption because of all of the inefficiencies in TradFi. So it's no wonder that stablecoins are pretty much growing on a trajectory that is completely different from the rest of crypto. Um, so you can kind of see this here, that the total aggregate supply of stablecoins have been growing nonstop since the last 2 years, and just in the last month, the stablecoin supply grew by 10 billion.
Mm,
Um, as Max has already alluded to, this means that there is now a lot of sidelined capital. This is not what we saw at the end of 2021, when it was pretty much chaos and people were just leaving the crypto market. And then this led to some of the fallouts that happened, like Luna and FTX and whatnot. So we're not seeing this time around. But this can also have a different interpretation, meaning that there's more usage of stable coins outside of crypto, and this is not reliant on the cyclical nature of the 4 year cycle that we're quite used to. And there are existing evidence of this, because there's a lot of fintech applications in Latin America and in Africa that are dependent on stable coins. And as we've already again alluded to, there are transactions being done and investments being done in stable coins that really have nothing to do with crypto per se. So yeah, that's a really cool thing to be mindful of. So it can either show you that there is a lot of capital that is waiting to re-enter the market as soon as things turn to in our favor, or just continue at least to be positively reinforcing crypto sentiment. Or it can also show that yeah, crypto is growing beyond its boundaries via stable coins.
yeah. And even if it's growing beyond its boundaries in the sense that this is no longer like necessarily being used in just the crypto world, but it has some real world usage, is in a way another kind of endorsement for stablecoins alone, but also for the fact that yeah, the industry is becoming mature now that it actually touches upon real world impact. So, nevertheless, I think a very cool chart and a very, bullish signal of adoption, if any. And I know I showed you guys this chart last time as well. This time it's a prettier chart actually because I recreated it myself. But aside from that, I think it's just a good reminder that, drawdowns are normal in bull markets. We see this kind of behavior, you know, in each market. We saw this last time in the 2021 cycle with the China ban. That actually led to another, cycle peak, and it wasn't the end of the bull market for that story. But altogether, this is a common kind of occurrence. And I think what's also a positive note to show, and it's also something that, we mentioned throughout this presentation, is that the drawdowns are getting less steep. Part of that is because we have far more deeper market participation. And while that does mean less explosive upside, it also means more organic, uh, you know, building of the market and of the current structure. So that is a positive, and we may, hopefully in someday in the future, we won't have these very steep drawdowns anymore, but we can just, follow market conditions that are a little bit less anxiety inducing, if you will. Um, Anyways, all in all, I think we kind of summarized a bit in terms of the macro side, particularly over what happened in these two in this slide over here with the tailwinds and headwinds. There's still a bit of uncertainty on the macro side. We need to get some more clarity, particularly for like the path to rate cuts in the US. It does still seem like two or three will be coming, but with tariff implementation, I think next week, this is going to become more clearer. And just in general, we also still have a lot of uh, kind of fears about, or not fears, but we do still see a little bit of deleveraging from particularly the institutional side. They're not dabbling just yet, but we hope that will turn. Anyways, we hope that you do. We hope that you did enjoy our session. If you want to check out some more of, the 21 Shares research, you can scan the QR code. All of our research is, free, accessible to anyone. We really pride ourselves on the educational side as well. And yeah, if otherwise, we will see you next week. And I think now we can make it open to Q&A.
Yes, we have one question already about, was the whale accumulation you're referring to large BTC holders like Tether supporting the BTC price and Sailor buying, or was there a real new demand from other institutions? What is the data of 21 shares indicating? Um, I mean, I think when we say long-term holders, holders or entities that have been holding Bitcoin for more than 160 days.
Hmm?
So it does mean that these are people that have already been in the market for quite some time. So it wouldn't necessarily be new entities. But it does also mean that you could potentially be seeing that there are some people that entered with a small size initially, and then as the market either cooled down or there were some more positive news, they were able to accumulate. But there isn't like we there is no granularity down to the entity of who these holders were. But since you've alluded to it, yeah, Sater has been buying. I think he's now the second amongst the three largest holders of Bitcoin. His stash is up to $44 billion. And I don't think this was Tether because um, Tether can only convert some of their surplus revenue to Bitcoin at the end of each quarter. So this we are about to find out if this was the case, I think, in the next month or two. So
Mhm.
it could be a combination between both.
Yeah.
Plus, we have been seeing a lot of corporates like Meta Planet,
I mean,
like
even GameStop recently just announced that they will
yeah,
be buying Bitcoin.
yeah, but I'm talking about companies that already did this, and we
Yeah.
saw in their filings. GameStop is quite new.
Yeah.
So yeah, I think there's like the corporate approach of Sailor. I think that the Sailorization, as is the term now being discussed within the crypto sphere, I think there are other companies, yeah, trying to go about this approach now.
Yeah. But I think this chart, yeah, as Kareem said, it's not necessarily on like size, accumulation by like wallet size or by whale or by entity, but it's more on like the accumulation by market participants in terms of how long they've or how active they've been in the space instead of what the size is of their holdings. So yeah, just to clarify that one. In the
Yeah.
meantime, while people think about questions on the topic of GameStop, I think that's really cool news. I mean, they reportedly have around, I think, $4.6 billion in cash. Um, and of course, we're yet to see what will be deployed in Bitcoin. But I think it's really exciting because, following the kind of short squeeze saga that they had a few years ago, they kind of wanted to use a lot of the cash raised to restructure a little bit. And I had a look at some of their numbers, and 2024 was the first year that they've actually made a net income since the short squeeze saga. And so some of that restructuring, which involved like closing, international stores and whatnot, may have actually led them to now be, you know, uh, making a profit. And as a result, they may be comfortable with their cash position and don't think that they need as much cash in hand. And so making an allocation to Bitcoin, a Sailorization of GME, I think it makes sense. Yeah, so it's quite a cool thing as well. And another point is 4.6 billion in cash is significant. It's really a lot that could be deployed into Bitcoin, especially if you think about the fact that this is just cash. If you look at how Saylor's done it, I think it's really impressive, of course, but they've only used around 600 million in cash payments for Bitcoin. So even if a quarter of this gets deployed by GameStop, it's around the same kind of market effect in terms of buying over the counter type of thing. So that's quite cool.
Yeah, yeah. That's yeah, we'll see. We'll see as we get more information about how they're approaching this. I doubt it will be the whole like all of their cash reserves, but it definitely
No, it definitely, yeah.
creates a more of a flywheel effect of other companies seriously considering this approach as a viable strategy.
Yeah. Well, it seems like we haven't received any new questions. I fear that we have, helped you guys so much that there's no need for us anymore. But altogether, I hope everyone enjoyed. I want to thank you guys again for joining our analyst call. It's a pleasure to have Kareem with us once again, and I'm sure he'll be back for the next session again. And if not, well, yeah, you'll see him soon. Take care, everyone, and yeah, see you once more. And let's hope that the market does in fact turn, as we've been saying today.
Onwards and upwards. Thank you, Max, and thanks everyone.
Cool. Thank you. Bye bye.